Hello everyone, my name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. AIF is nothing but alternate investment funds and PMS is your portfolio management services. So we are one of the largest platform for alternate investments and portfolio management services. And at AIF and PMS Experts India, we keep organizing these knowledge-based sessions. We invite different industry experts and we try and read their mind. So this time with me, I have Shashi Singh. I know Shashi for quite some time now. She's the chief business officer at Singularity Holdings, uh, uh, which is also owned by Mr. Madhusudan Kela and his family members. So Shashi brings about almost 2.5 decades of experience, 2.5 decades of rich experience in terms of raising funds at various organizations. She was heading IFL, India Infoline Asset Management Business. So she laid down the foundation initially when AMC was building up. She sort of scaled up the business to the large level, and then she decided to come on the private equity side. So we thought who would be the better person to talk about the investor themselves, because they have complete skin in the game and they put their own money, which is pretty sizable. So we thought, and then they also run structure for public investments, public money as well, where they allow some of the large ultra HNI clients or family offices to participate, who have a similar sort of thought process and get along, I mean, in sync with their thought process. So not necessary that they would invite every client to on board. So very, very selective that way. So we thought we'll discuss about what are the challenges which are faced by private equity investors in India. We'll also talk about what are the opportunities which are there now, because this particularly cat 2 category AIF, which is private equity, is shaping up very well. Is shaping up to an extent that the total size of the industry, the AIF per se, has reached to now more than 6 lakh crores as we speak, because we keep a strong track on this number as an expert. And out of which your cat 3 is 70,000 crores. So minus that, so your cat 1 and 2 put together is about 5 lakh and 30,000 crores. So we see huge amount of value migration. There are a lot of stories also, like Mr. Yash Kela, who is involved in Singularity Holdings as a part of the investment team. He's also invested in a couple of other ideas like Oyo and Ola, where they've made more than 100x, along with Mr. Anirudh Damani. So clearly, I see that huge amount of wealth creation is happening, and therefore I thought I'll invite Shashi and try and read her mind, understand where it is headed. So Shashi, firstly, thank you so much for accepting our request and taking the time out from your busy schedule and agreed to do this show with us.
Thank you so much, Vikas. And it's a pleasure to be here to talk to investors. And any time now is a good time to talk about private equity to our investors, because over the last decade, we've seen private equity grow exponentially in India. But most of the benefit of this growth has been taken by institutional investors and not domestic investors.
Right.
It's only over the last 3-4 years that we've seen domestic investors, HNIs, and family offices coming and participating in a big way.
Right.
Having said that, we see a clear decade in front of us, which will be a unprecedented growth in this segment. So, always happy to talk to investors
Sure.
on this segment.
Thank you, Shashi. So the format of the show is, because we keep talking to our investors, they keep giving us their questions, concerns, and queries. So I'm going to ask these questions one by one. Total duration that we have is 45 minutes, and we'll
Yeah,
try and cover as much as possible. So
sure.
the first question is, because you've been doing this, can you talk to us about your internal structure? How do you do it at Singularity Holdings, and what all things that you do?
Yeah, so just to briefly introduce ourselves, we're a part of Mr. Madhusudan Kela's family office. And this was started in 2017 when Madhu quit from Reliance and set up his own family office. At that same time, till then, Madhu was doing only listed equities, and he's a veteran in that business. But we realized that from companies, the growth that we are seeing, 40 to 50% of the growth is pre listing, and then you see post listing growth. So if one needs to capture that 50% growth of a company, one needs to be invested in the company far before it gets listed and not after getting listed. And that's how we said that from our prop, we'll do a sizable allocation to private equity also. We started allocating capital to private equity across early, growth, and late stage. So this was led by Yash and mentored by Madhu. And this was only proprietary capital that we deployed for the last 5 years, where we did two things. One, we invested in companies directly, and we invested as a fund of fund in a lot of funds. Uh, it's been a good learning. We've got an IRR of 44% in these years
Nice.
from private equity. So definitely private equity is here to stay, and India is the country where we're seeing growth, and therefore I would say each investor should have at least 10 to 25%, depending on the risk appetite, the risk profiling, allocation to private equity in their portfolio.
The other thing which I wanted to know is, so how is this structured? Like, you have you see that Mr. Madhu Kela, Yash Kela, all of them gets involved while evaluating the company, and which are the sectors that you look at, and what are the 2-3 things that you look at before investing in those companies?
Yeah, so coming from the capital markets business, what we did was we went top down. And from the family office, there are two businesses that we run, listed equities and private equity. Listed equity we do under the name of MK Ventures, and private equity we do under Singularity AMC. And why we call it AMC? Because we've started taking external capital through the CAT2 AIFs now. Primarily, the listed equity, private equity is led by Yash Kela, mentored by Madhu. Of course, he's a chairman of the IC committee, and every proposal is run through him, and a lot of guidance that we get from him on valuation, assessment of business prospect, business environment, everything. But coming back to the point as to how do we select the company, so what we have done earlier in the stage is that we identified 8 to 9 themes that we feel will have a multiplier growth over the next decade. So there are these 8 9 themes, and it's no rocket science to know what will grow, but we've identified them as themes for our business purpose: health tech, ed tech, fintech, enterprise SaaS, consumer goods, women consumption on internet, which over the last 3 years has increased 10 times. So any product that feeds on women consumption on internet would do well. So what we normally do is, within these identified themes, we look for the top 2 3 companies that are coming. Our more focus is on tech driven companies, because we feel that across the businesses and sectors, the disruption will be through technology, digitization. So we look for tech driven companies in these themes, and we try to stick to the top 2 3 players, because we always feel that if there is a good idea, the top 2 players will command a majority market share, and the balance will only be laggards in the business. So that's how we've seen. Our view on the market is with a 10-year perspective, and we are very bullish on the Indian market.
So the other thing is, so the current structure that you're running in CAT2, let's say any of your investor is or a family office wants to participate. So what is the kind of minimum commitment that you look out for?
So what we did was, see, primarily, as I said, we are a family office, and we have a large prop that we manage ourselves. And since Madhu's a known person, a lot of large investors came back to him saying, "Why don't you invest our money along with yours?" So the CAT2 AIF, the purpose was to help larger investors who to invest their money the way Madhu invests his own money. So it's like co-investing. In our AIF, we ourselves has a large allocation. It's not like a sponsor. We invest at least 10 to 20% of our own capital there. So and investors like co-investing in the AIF. We also said that we don't want to go to the long tail of investors. So we've kept the minimum as 5 crore. And at 10 crore, an investor gets the benefit of co-investment, because we are saying any large investor would want to take a larger share in some investee companies through co-investment route. So we should offer that to all investors.
Who's giving 10 crores will have an opportunity to invest some of the identified ideas that you you do it in the AIF structure.
Yes,
Over
yes.
and above. Yeah.
Yeah, and
Okay.
see, when we invested in funds from our prop, we realized that while the investee companies of the funds are very good and doing very well, the IRR to the investor, us as an investor in the fund, is very diluted. So, hamara IRR in the funds was only 22-23%, as against a 60% that we got in our direct investment portfolio. And the reason was not that these funds were not doing good investments. There were two main reasons that we identified for dilution of this IRR. One was longer than required tenure. So, if your investment is normally underlying investment is 4 to 5 years, the AIF would be 8 years or 9 years. That's because every institution wants to keep some buffer on fundraising. तो 2-3 साल fundraise में लगाएंगे, फिर exit में हमको buffer चाहिए तो 2-3 साल का exit में buffer रखेंगे. But who pays the price for this? It's the investor. It's we who pay the price for this, because then our IRR gets diluted over this. Secondly, a very high management fee, because supposing normal structures in the market are 2 and 20, so 2% management fee over a 8-year period is like 16% goes off in your fees. So actually 84% capital is put to work to generate IRR for that 100%. So we felt if these two things can be solved for larger clients, and it makes a difference for larger clients because the pool of capital is large, then we could, optimally use the capital and get better returns. Ideally, we say that if one has to invest in uh, debt, he should look at whatever other returns, 6-7%. You do structured debt, you should look at 10, 12, 13% return. If you want to do listed equity, you should look at 15 to 18% return. And likewise, if you're doing private equity and you're taking the risk of locking in your money and huge capital risk, then you should not look at anything less than 24-25% return. Because if you have to generate 17-18%, like how most of the private equity funds we're seeing, then it's better to stay invested in listed equity where you're getting your liquidity. So we said that let us these funds which are for large investors and do a shorter tenure, lesser management fee, so that people can derive the full value of the underlying investments.
For profit sharing structure, is it?
Yes, there will be a performance fee of 20%, which everyone charges, but primarily performance fee is not a drag on your returns, because that's a percentage of the overall performance that is generated. What is a drag on your returns is the fixed fee that you're paying, irrespective of what is the return generated on the portfolio. So ideally, any savvy investor would be happy to share a performance fee, but will want the fixed fee to be reduced as much as possible.
Can you talk to us about 2 or 3 ideas? I don't know if your compliance allows you to speak about some successful ideas which work very well under the private equity platform.
See, while I'll take 2 minutes to explain you the whole private equity business and how it could be segmented further to make it easier for investors to understand.
Right.
So, private equity is a large domain. We split it into three parts basically: uh, early stage, growth stage, and late stage. Early stage is the very early stage when there is an idea. It's right from an idea stage where a person's got an idea and he knows what he wants to do, and he needs some capital to put that. That's called early stage. It is very long tail, because once an idea is put to work, it takes a long time for the company to start working and getting the product out and then generating revenue. Generally, this is the most risky stage, because you're getting in too early and you don't know whether the idea will be able to be scaled up or not. Many times there are good ideas, but they might not get scaled up because of want of right technology, right market, right capital, timely capital. So there can be many reasons for an idea to fail, and likewise many reasons for an idea to succeed. So the mortality rate in early stage is the highest, but you get a lot of deals in this, and therefore in India you'll see 90% of the funds that we see in the country are all early stage. If I have to split it series wise, normally you will find private equity between series A to series D, E, F types. Now, pre-series A and late series A is all early stage where we count, where
Yeah, like cat one.
idea stage. It could be cat 1, it could be cat 2 also.
Sure.
And post early stage is the second stage, is the growth stage. This is the main stage of growth of a company, wherein the idea has been implemented, the product is out, the company started making some revenue, but they're still not profit making. Now they enter the growth stage, which is normally series B, C, D, where the company only needs capital to scale up their business. There is no idea risk, there's no product mix risk, there's no market risk, because everything is established. So if in an early stage there are 10 companies, two will come out winners as a growth stage. Normally you don't find too many funds in growth stage, because growth stage is the time when there's no risk except for scale risk, and the scale risk is directly proportionate to capital, because if they keep getting capital, they will grow. If they don't get capital, then their growth will get a little shunted. But there's no risk of product jamega ya nahi jamega, whether it will be accepted in the market or not. Normally in early stage there are institutional investors, and winners of early stage which come to growth stage, जो successful हो गए हैं, are lapped up by these institutional investors, and therefore you don't get early stage investment idea, growth stage investment ideas in the market, and therefore you don't see a lot of funds in that segment.
Right.
Sequoia, Naspers, Matrix, all these institutional investors will lap up these growth stage. Now, we as a family office operate in the growth stage for external capital. There is a reason why we have access to transactions over here. Most of the founders at growth stage, when they reach, they'll have institutional investors on their cap table. But they look for some large family offices, because institutional investors don't provide two types of capital which they need in their growth stage. One is a bridge round. Now, what is a bridge round? A bridge round is when between two capital raising rounds, say Series B and Series C, if I need a small capital not equal to a big round, because I'm entering a new market, or I've got a new client, so I need a small amount of 50 crore, I don't want to raise a 200 crore round, so what do I do? Now institutional investors don't provide bridge, and therefore founders will like to have some family offices on their cap table like us, who can provide them bridge capital. Secondly, at growth stage, founders start. There are some early stage investors who need an exit, and founders want someone to put in capital for this, providing exit to the early investors. Again, institutional investors don't give money for such secondary exits. So then, family offices or capital pool like ours comes in handy. For this reason, and the third reason, at growth stage, a founder starts thinking about listing his company, and therefore he wants some mentor who can guide him how to structure his business or balance sheet, or what to do, what not to do, so that his listing is good, and support him in listing. In that also, Madhusudan Kela's office comes in handy. And therefore, we found that in the last 6 years, we've got very good inroads into this private network, and we are getting very good transactions alongside all the institutional investors. And that's the reason we decided that we'll operate only in growth to late stage, because we feel lowest risk and highest return in the private equity is in the growth stage. So we operate only in series B, C, D, growth to late stage, mostly, and very tight tenure. So our first fund, which we just closed, Singularity Growth Opportunities Fund 1, was a 6-year fund and a 600 crore fund. We've just closed that fund. So in this now, where do we invest? The question was, where do we invest? How do we invest? So
Right.
as I said, we have selected themes. Within that, we said we'll build a portfolio of 50% consumer companies and 50% enterprise companies. On the consumer side, we're looking for D2C companies which cater to which have a product which will cater to the mass public of the country. So it's a mass product. And I'll come to some examples of what I mean by that. So Indian company catering to Indian mass public. On the enterprise side, which is B2B, We're looking for companies which are making products for the world. These are basically technology services and products. And so these will be Indian companies which will become global because they are making products for the world. That's and this becomes a natural hedge for us if you make a 50-50 portfolio of enterprise and consumer. And that's how we go about it. So whenever we are investing, apart from just the objective and the thesis, the core remains that how can you optimize the cash deployed, make it most efficient, and get the best returns. So returns is primary for us, and therefore, like making a mix of consumer and enterprise companies and hedging against any market fall in India or overseas is one of the strategy towards that. So coming to the example, like on consumer side, we've invested in a company called M Caffeine. M Caffeine is a personal care brand. I'm sure all of y'all must have come across it. It produces skincare products for both male and female. Now, this is a company which has got skincare products not in the luxury range, not in the lower range, but in the mid segment. Today, everyone can buy M Caffeine products and they're excellent quality products. So, that's the kind of companies we would want to back on the consumer side. On the enterprise side, like we've invested in a company called Servify. Servify is a company which provides after sales device management, service, warranty, everything for an OEM like Apple, Samsung, Xiaomi for their mobile phones, for their tablets. So once you buy an Apple phone, and Apple had a long Apple care, service centers, but now all that is serviced by Servify. So at the back end, white label service is provided by Servify for Apple, Samsung, Xiaomi, OnePlus. Servify today is present in 48 countries. India is only 30% of their total business, and they provide these services. So they are white label services. So to all these countries, Apple, Samsung, HP, Xiaomi have taken them. And they have to just plug and play their technology services for all these OEMs. So this is how we build our portfolio. We target a return of about 25-30%. As I said, in private equity, it shouldn't invest if you're looking at less than that returns.
Right, right. So coming
And
back to our
having
topic, yeah, sorry, please go ahead.
and having Madhu with us, it helps us in remaining very conservative on the valuations. So
Right.
while we've seen in the last 1 year so much fall in the valuations, our portfolio has gone up. All our companies have got valuations which are higher than what we invested at. That's because we're very, very conservative in investments.
Yeah, so two things. One, there is this myth around that, when you look at Series B, Series C, or onwards, by the time you get these companies, the valuation really go big time high. So then the chances of making money from there onwards becomes very less. Do you think so?
See, as I said, that pre-listing companies 50 to 40 to 50% growth is done pre-listing. So you would have a lot of money to make even if you enter at a growth stage and stay invested with the company till the IPO, which will be at least 3 to 5 years post your investment. You'll make good money. We don't do a lot of pre-IPO. It's opportunistic because same thing. If at pre-IPO stage, there's less left on the table to make till the listing of the company.
Coming back to the topic, so it talks about the challenges which are faced by investors. So couple of questions there quickly. So generally these investors, when they invest, how do they get the valuations, like on what parameters? Because ultimately you make money only when you take the exit, otherwise these are all on the papers. So firstly, let's talk about in papers also, how do you evaluate and who are the auditors, and then we'll talk about the exits.
So normally, every company, every private equity fund is governed by SEBI, and SEBI has very strict prescribed guidelines for valuation. So there's a methodology prescribed, and the top four auditors audit the valuations, and the valuations are done from SEBI approved agencies. But in a layman's language, I would say that valuation is nothing but what the company has projected and what it has achieved and what's the run rate of that achievement, and there is a multiple given to that. Now, the multiple is the table is defined as per SEBI as to what multiples can be given. But in the market, you can have higher multiples or lower multiples. If it is lower, the company is available at a cheaper cost. If it's higher, the company is available expensive. So just to give you an example, normally at growth stage, and these companies may not be profit making, and therefore they're not valued at EBITDA. They're valued on their revenue that they generate. So generally, companies could be valued at growth rate between 3 to 5 times their revenue. Okay, but we would have seen a lot of investments being done at 10 times, 15 times, and those are the companies where we are seeing a fall in the valuation. We as a policy do not invest in any company above 5 times revenue multiple.
Wanted to understand more from you what's happening in the private equity space. We see a lot of people are saying that Baiju's valuation has gone down, whereas those who have bought, they're saying that it is at the same level. Not particularly Baiju's, but overall, we are seeing and witnessing that in last 9 months, 10 months time, these companies' valuations have become questionable. So, what is your house view on that?
Yeah, so as I mentioned, it's an extension as to what valuation or what multiple will you give to a company. And we've seen earlier, like what happened to Ola, Zomato, or Paytm. If you don't have a visibility on your bottom line, and you're say incurring cost for client acquisition, so while you're generating a revenue but there's no visibility of bottom line, because every client you're acquiring is a negative to your balance sheet, then what kind of valuation should be given? While the growth run rate might be very high, you still want to give a valuation that was given? So that's the re-rating that's happening in the market globally. uh, Earlier what had happened is, in very simple terms, uh, because these were all tech driven companies, technology platforms, the growth was very fast because there were no boundaries. And because this, so supposing an HUL took 10 years to reach a 100 crore valuation, say for example, and today's digital company might take 1 year to reach that kind of revenue, then someone is trying to give a multiple 10 times more than HUL to that. So it was going a little insane, but we're seeing that correction happening, and sane valuations coming. So while revenue run rate or the growth rate of revenue is given a valuation, there is also now a lot of expectation of visibility of bottom line. While the top line is growing, bottom line visibility should be there, and that's how now people are looking at valuations.
Okay, great to know that. So, can you also talk to us about so this particularly we talked about Cat 2, and you also manage some family office money. Can you talk to us about co-investment opportunities? Like you mentioned that there are a lot of investors who makes good money more than the funds. Is that what you are also witnessing at your fund level or no?
Yeah, so see, it's like this. So when you've invested in a lot of funds, and we as a family office are today invested into 13 funds, you get a lot of co-investment opportunities from there, like we give to our investors from our fund. First fund, we've already offered 2 companies in co-investment. And it's up to an investor to take a call. Say for example, I'm offering XYZ company, that in the fund it is 20% of my portfolio, but if you want to take more, then this block is available with me and you can invest in this. Now if an investor has liquidity at that time and is uh, thinks that the growth story of this company looks very sound, and he's wanting to bet more money, you buy more of that stock. And if that company does well, you're actually making more money. Co-investment is a very good opportunity for large investors, because then you're taking a bet on a single stock which has already run up a little bit and you know about it. Like in my erstwhile company in IFL, we had given co-investment in NSC, and people took co-investments, have been making good money on it.
So, what are your plans? Like, are you? So, how do you want to structure your organization? Like, you will have more opportunities in the Cat 2 AIF form, or how is it?
So, two parts. So, Singularity, which is our private equity part, will continue to operate into three basic verticals of business. Cat 2 AIFs all across, but first segment we will operate into growth to late stage investments into companies. So, like I said, we've just closed our first fund. We'll do fund 2, fund 3, fund 4. And in every fund, the sponsor will put in, which is the family office, will put in 10% of that capital. In a way, we are saying that family office, whatever investments we want to do into growth stage will be done through the fund, and other investors are welcome to join us and invest alongside us in the companies that we like and we invest in. The second segment we'll operate in is fund of fund. So our first fund of fund was our proprietary fund of fund, but we've got excellent returns. So we will continue to make fund of funds. But the idea there is to collate a group of funds for investors which are ideally not available to them. So there are many good funds which are only available to institutional or large investors. Can I get that fund for my investors? Or there are certain funds which are only available to institutional investors and not HNIs, even if you have large pool of capital. Can I get that? Then there is one very important thing that we will play out through our fund of fund. Supposing there is a 10-year fund. Now, I don't want to enter into a 10-year fund, but after 5 years, some investor wants an exit. Now I know the complete portfolio of the fund. I know how the fund is doing. If it makes sense, I will opportunistically buy that fund and I'll have a residual tenure of 4 5 years. So my investors get only 5 years fund against a 10-year tenure of that fund. And I get a lesser risky fund because now everything is visible of that fund. And also we will, in our fund of fund, we will take opportunity of, we will keep 25 to 30% for co-investment opportunities that all the underlying funds might offer. We'll also try to access strategies which we are not doing, or we don't have the capability to do. Like, say, we like buyout strategies a lot, so we don't do buyouts, complete buyout or majority buyout strategy. So if there's a good manager, we'll back that fund. We like healthcare segment a lot, so if some one wants to do a fund only on healthcare, we'll support them through this fund of fund. So these are the kind of things we'll do through the fund of fund, which will benefit our investors. And thirdly, we'll have a co-investment platform, which will be a big platform where we'll offer all our investors of the fund, we'll keep offering them good co-investment opportunities so that they can increase their allocation on individual companies. So that's where Singularity will operate: fund
Yeah.
of fund, co-investment, and growth to late stage platform. On the MK Venture side, we continue to operate on the listed equity side. Currently, we don't run any AIF over there. We do advisory mandates for large clients. We take 50 crores and above advisory mandates, but we are thinking whether we should do a Cat 3 AIF or not. That's
Okay.
managed by Madhu directly.
So, any plan to come out with your own PMS, or because you have recently acquired license, also PMS license?
Yes, we have a PMS license, but I don't think we're managing public money on the PMS side yet.
Understood. Understood. Great. So, Shashi, coming back to this topic. So, here we talked about, as I said, that the industry AIF is shaping up big time. Size of the industry is growing 6 lakh crores, and Cat 3 alone is 70,000 crores, and Cat 2 is the maximum portion. And you work with large organizations like IFL, you were heading the entire aims, and they've been doing this for many years. So, what is your sense 10 years down the line? What can become any number which comes to your mind? Because we saw mutual funds growing in front of our eyes for 20 long years. Uh, do you think that AIF and PMS put together can become equivalent to mutual fund industry 10 years down
Well, last 8 9 years I've been fully into private equity and alternate investments. And I would say what mutual funds have achieved in 20 years, AIF should achieve in the next 5 6 years. Already, if you see, not through AIF but directly, the kind of money that has gone into private equity businesses is way ahead. It's a huge industry today. Okay, and I don't want to quote numbers here, but that's a huge number. Just that that money is not fully rooted through an AIF platform. It could be a SPV, it could be a direct investment, but there's huge money going there, and we feel that this is bound to grow for two reasons. One, lot of new businesses emerging within India, and therefore there will be a lot of investment happening in these companies. Secondly, a lot of global investors want to invest in India now, as that's the only right option available. So the next decade belongs to India, which we hear from everyone today on the private equity side. And everyone knows that we have population on our side, young population on our side. We have a very, very entrepreneurial genetics within our people, and
Right.
with the government pushing a lot of initiatives on entrepreneurs to start their own businesses. The Startup India is a big initiative which is happening. We feel a lot of businesses will come in on this side, and therefore a lot of funding will go through the AIFs. My urge to all investors is to do some allocation to private equity always, because this will, for the next 5-10 years, this will give you better returns than listed equity.
You talked about foreign investors. Is there a mechanism we can see that how much money has come from these foreign investors? A, B, do they have direct access to Indian companies, or how does it work? Like, or they do it through funds like yours? Uh, just wanted to
Yeah,
know.
so these are like very public data. VC Circle and all keep publishing the data. Even SEBI has some data now. SEBI publishes some data on the total external capital that's come. There are multiple routes through which external money can come. Like Government of India itself runs some 3-4 fund of funds where they invest in Indian funds, but they're at the back end, they've got sovereign funds of various countries investing with them. So that is one way institutional investors are coming. Institutional investors have direct access to the funds, and they can come in the funds directly. They can also come in the companies directly. So, and there are offshore funds who invest in India. So they'll have their LPs who are offshore investors, and through that fund also, like Sequoia and all these are offshore funds who invest in Indian companies or Indian funds. They raise money from outside and invest in India.
Right, right. Now, why I was asking is because when I see last decade or so, we saw more than 100 unicorns emerging from India. Indian investors have not made money. Only the
They've not.
foreign investors made money because they were the one who actually deployed their own money at the beginning of the era.
Yes. As I said in the beginning, that while there has been huge money that has come in and has benefited from the huge growth of our companies, and there have been good returns, but most of the investors who benefited from this growth is only offshore investors. Because Indian investors, HNIs, have only started investing now.
Right. So I was also kind of, because we do this study completely on alternate investment funds, and some data points that I was referring to the other day. When you look at the developed economies, which are like, maybe you can look at US, is the most biggest market in the world. Their private equity, the HNI investors, their exposure in private equity is as high as 20% vis-a-vis India, which is not even 0.5%. So ये जो
Yes.
100 यूनिकॉर्न बन गए उसमें एक रुपए भी नहीं बना इंडियन इन्वेस्टर.
Absolutely. In fact, we keep meeting a lot of large ultra HNI customers. And over the last 4 years, 5 years, the change that I've seen is that earlier these guys were used to talk about 10% allocation to private equity. Now everyone is looking at 20% allocation to private equity, 25% allocation to private equity. Even advisors like IIFL Wealth or Kotak Wealth or Julius Baer would advise meaningful allocation to private equity now.
Yeah, because
So
see,
asset allocation becomes very important. Within the
absolutely.
asset allocation, earlier pehle debt or equity hota tha. Now it's debt, equity, and private equity.
And I would say that to some of the investors, I mean, those who are looking at, say, equity plus kind of returns, but then don't want to take risk. I said, why don't you have 25% exposure to private equity space?
Yes.
Because even during the bad times, because there is no direct index, these companies don't have that kind of volatility. So in terms of volatility, it is just half. But at the same time, you're not compromising anything on the return side. All you require is good amount of patience to sit back, at least for 6 7 8 years, because that's a minimum cycle that anybody needs to ride
Yeah,
through.
yeah.
Otherwise making money is not possible. The last question from my side before we get on to the Q&A, if there is any investor who wants to ask. Generally, it has been observed, Shashi, is that when you get the interim valuation report after investments, even you look at your previous funds of IFL and here also, the interim valuation doesn't give that kind of excitement to clients, because that will not have a sort of realistic number, because that you get it only while exiting. What is the gap? Can you throw some more lights on that?
So I'd define it like this as to which fund one we're talking of. If it is an early stage fund, normally when a company is just started and growing, it's incurring more cost and it's EBITDA negative, and the revenue, while it's growing, it's still not making profits. At in such a stage, while we show that the growth of the company is 100%, 150%, bottom line is not there, and therefore that valuation which comes is slower to pick up. But at growth stage, if you look at like the funds that we operate in, normally these companies become profitable soon, and because they're already at growth stage, and you see good valuations initially in the fund. Any fund which is in the fundraising period does not value its investments, and therefore it's valued at par, but it's charging a fee. So you will normally see your NAV as a negative NAV from where you invested, but it's not negative because your investments are not giving any returns. It's just that वो 10 रुपए पे ही वैल्यू कर रहे हैं आपका इन्वेस्टमेंट, और आपका 1% 2% जो भी मैनेजमेंट फी है वो चार्ज कर रहे हैं, तो उतना नेगेटिव है. But the day they start valuing their investments, which is after the final close, the NAV will shoot up.
And the auditors are also, I think, advised by the regulator, which is rightly so, that you have to give realistic numbers,
Yes, so it is very
or
conservative
rather
valuation.
conservative. Yeah.
Yeah, yeah. That's SEBI defined actually.
So a couple of questions. So one is, how does the taxation work here? So well, we are not the tax expert, but maybe I would request Shashi to just give us the broad framework. How does it work?
So Cat 2 AIFs have passed through taxation, which means taxation is in the hands of the investor, but primarily depending on the exit. Now, exit can be either through listing, then it's listed exit, then it'll be capital gains on listed equity, and if the exit is through a secondary sale to in an unlisted format to another fund or investor, then it'll be long-term capital gains on private equity, which is 20%. So that's how, but it's all capital gains, no business income.
Capital gain, and I would urge all of you to speak to your chartered accountant, because they are the
Yeah.
right people to give you the correct advice. But this is how broadly it works.
Yeah, it's normally capital gains. It's always long-term capital gains because these are long tenure funds and you don't do less than 1 year or 2 years.
Right, right, right. The next question is, your equity, private equity, and listed equity both are giving equal returns. So, what is the point investing in private equities?
Yeah, if you're investing in private equity and generating 17-18% return, then I would say you're better off investing in listed equity because you at least have liquidity in your hand. Ideally, you invest in private equity to get a return anything above 22, 23, 24, 25%. Then only private equity makes sense. And yes, I agree, there have been many private equity funds, and that's what I was saying earlier in the chat, that private equity funds have generated lesser return, and customers have logged in themselves for 6 years, 8 years, 10
Right.
years, and have generated 17-18%. It made no sense because your listed equity portfolio would have given you that return.
Yeah. On top of that, you have 20% taxation also.
Taxation also. So there, this is where assessment of a right private equity fund, right stage where you want to enter, depending on what your risk profile is, what your profile for locking in your money is, You should look at all those. Just don't get swayed that okay, today it's very cool to be in private equity and therefore you should invest in private equity.
Well
It
said.
makes doesn't make right sense unless you assess the fund correctly.
Right. And you have to have a realistic expectations also. Just because
Yes.
money is in private equity doesn't mean that every time it will show you 25%. You have to look at from time frame that or the commitment time that you've given to the portfolio manager. Like if
Yes.
you have given 7 years and every year you're saying 25% nahi ban raha hai, 25% ka baat hua tha. So that's not possible. That's not the way the fund is going to operate.
No, in private equity, you will get to know of your IRRs only in the last 1-2 years of the fund and not in the earlier years, because that time the company is growing. While every fund does a quarterly update and gives some guidance on the underlying companies, how they're growing, that will give you some idea. But actual money that you receive and the IRR that you receive will be known only in the last 2 years of the fund.
Right. Absolutely. With that, we'd like to conclude our session here. It was a pleasure speaking with you, Shashi. As always, you've given a lot of insights to our investors, and on behalf of all our investors and team, I take this opportunity to thank you once again
Thank
for
you so
taking.
much. Thank
Yeah.
you for having me. Thank
All
you.
right. Thanks, my dear investors. If you have any questions, please write to me, or you can reach out to my team at experts@aifpms.com, and we'll help you. If you want to speak to Shashi, we'll get the call organized. Thank you.
Thank you so much. Pleasure's
Thanks.
mine.